Hi, I'm Bill with Mining Stock Education. Thanks for clicking on this video. We appreciate it. In this video, you are going to be hearing from 3 expert presenters from our recent live investor summits that I've hosted with my business partner, Carrie Lutz of the Financial Survival Network. You are going to be hearing from Craig Hemke of TF Metals Report. He's going to present an expert gold commentary. Then you're going to hear from Collin Kettell from Palisade Global about why you need to be investing in uranium equities. And finally, you're going to hear from well-respected fund manager and author Adrian Day about why you should consider investing in gold royalty companies. If you're not on our email list, make sure you click on the link in the show notes below, get on our email list, and you'll get invitations to our live investor summits. At these live webcast events, you are going to be able to hear quality mining investment opportunities, hear from the mining company management themselves, and have an opportunity to engage the mining company management through live Q&A. So make sure you get on our email list. Without any further ado, let's jump right into it.
His site is tfmetalsreport.com. Craig, you are arguably one of the top gold analysts around. Like I said, you find him at tfmetalsreport.com. Really appreciate your coming on with us.
Well, thank you, Carrie. It's a pleasure to be with all you guys for this presentation. And I think if I can serve a purpose today, would be just to kind of bring everybody up to speed on where I think we are with the metals sector in general. And this is important because as great of a company as Orion is, we also need sentiment in the sector to improve. Because at present, after this last 6 years of what we've dealt with, and I'm speaking specifically to gold and silver, but it carries to the whole sector, into the mining sector. I mean, sentiment is so depressed that we really have very little interest, both from the retail side, but even more importantly, from the institutional side in the mining sector. And, you know, the old phrase is about a rising tide lifts all boats. And that's certainly true with our sector. The last time we really were cooking, back there in 2009 through 2011 and into 2012, it was really a good time for everybody. And I think that's where we're headed again. And that's what the main focus of my brief little presentation here is today. In that I recall quite well the reaction to the metals as the world moved out of the great financial crisis in 2009. And if you recall, in 2009, this whole grand monetary experiment, if you want to call it that, by the world's central bankers began as they tried to reliquefy, reinflate, remonetize, whatever, all the global markets. And the first step of that was QE number 1, the first quantitative easing program, which was unprecedented, which was described at the time by Ben Bernanke as a one-off. He tried to tell everybody it was not debt monetization, though when you're buying treasuries, I'm not sure how you can make that differentiation, but that's exactly what he tried to do. And we were convinced that, or at least they tried to convince us, that these monetary authorities had things under control, that everything was fine and everything was going to get back to normal. And so as we entered 2010, the world looked a lot like it does now as 2019 is beginning. And that has been a thesis of mine at TF Metals Report ever since late last year. And now here we are. In May, we got a third of the year behind us, and it's amazing, to me at least, the similarities of how all these things are unfolding in 2019 versus 2010. Of course, this is very important because if you're in the sector back in 2010 and 2011, you remember what happened. Not saying that we'll get an exact repeat of that, at least certainly not, maybe not in terms of prices, but history does rhyme, as most everybody knows. And if we can get some now rallying prices, particularly in the precious metals, I think that spills over to the entire sector and creates a positive environment for all miners, regardless of whether they're mining precious metals or industrial metals or whatever. And you get those institutional fund flows into the sector, there just aren't a lot of good opportunities. There aren't a lot of opportunities in general. And that money starts just looking to go wherever it can go. And then it seeks out great companies like Orion, and it really tends to accelerate the returns to the upside, benefiting everyone, the company, the investors, the shareholders alike. So in just these couple of minutes that I have here, you look at this slide, I just want to draw everybody's attention to what I think are just the basic tenets of this theory, that 2019 is a lot like 2010. And again, you go back to where were we in 2010? We were coming out of the great financial crisis. You were told by Ben Bernanke and the rest that QE number one was a one-off, and that the economy was recovering. The big phrase back then was green shoots. I'm sure everybody on this panel, most everybody listening, can remember how many times on CNBC or Bloomberg you heard that term green shoots about how great the U.S. economy was beginning to recover and how great it was doing. In fact, just to show you how similar some of the numbers were, in the second quarter of 2010, the U.S. GDP grew at 3.7%. We were just told a couple of weeks ago, and you could say maybe these numbers are massaged a little bit because of the inflation component of it, but nonetheless, we were told Q1 GDP this year was 3.2. So we're kind of bumping along at the same rate that we were as 2010 began. But the problem was, as 2010 continued, the economy began to slow. And by the second quarter, we were down to 3.0%. And in the fourth quarter of 2010, we were down to 2%. And by the first quarter of 2011, GDP actually contracted at 1%. Now, again, what are you hearing from the Fed now? And what are you seeing, if you're looking at PMIs or inflation numbers, manufacturing numbers, car sales, you name it. Clearly, the economy is slowing. The yield curve in the U.S. is inverted. That is always a precursor of recession. And so we're headed right down the same economic path in terms of growth as we were in 2010, from about the same starting point. Okay, so then what did the Fed do? The Fed was trying to appear in control. We were told that QE number one was a one-off. But what happened? Everything started to slow, and in November of 2010, we got QE number two, another $600 billion in QE. And that was when the metals, particularly gold and silver, really began to soar. As you look then, this recognition that Fed policy had reversed started to shake confidence in the dollar, started to shake confidence in the central bankers themselves, that they had things under control. And then throw this on the fire too. In 2011, we got into all kinds of political discord. Republicans controlled Congress against a Democrat president. You had the debt ceiling debate that was raging. There was, as a consequence of that, S&P downgraded the U.S. debt for the first time. Well, gee, look at 2019. We've got Democrats that control the House of Representatives talking about impeaching a Republican president, right? You've got, do you know we're up against a debt ceiling right now? That actually kicked in March the 1st. And so we're currently operating, Secretary Mnuchin is currently operating the Department of the Treasury by moving funds around because we've reached our debt ceiling, our debt borrowing limit again. That extends now to a date of September 1st. So now we're going to go through the summer with that hanging over our heads politically. And Moody's is already talking about a credit rating downgrade. So again, you can see how many of these forces are aligning in 2019, just as they did in 2010. And then you add on, of course, the differences now here 8 or 9 years later. I mean, we're up to 22 trillion or nearly 22 trillion in debt. The U.S. Fiscal deficit is, as far as the eye can see, exceeds $1 trillion a year. We're even now talking about this crazy idea of modern monetary theory, where apparently we can now have guns, butter, and everything else by printing as much fiat currency as we need. And all of these things are set to drive global demand for gold, even at the retail level. On top of that, though, we're seeing massive buying, record buying. In fact, going all the way back to the 60s and 70s, the amount of gold being purchased by central banks, 651 metric tons last year, on a pace already this year to meet or exceed that. Anyway, all these things combine for a pretty bullish outlook. We've been stuck now since 2013 in a pretty tight trading range. And I think it has put a lot of people to sleep. I can see that just in the reaction on my website. I think it's made a lot of other people complacent. And so now here we are. So Carrie, if you could just do me one quick favor as I wrap up, please take a look at these next two charts. I've got a chart of COMEX gold from 2010. And I think it's very important that people, again, recognize their history. We talk about how much 2010 is like 2019, at least from a fundamental and political and central banking standpoint. Well, look at price. As you can see on the lower left, we began the year in COMEX gold in 2010 at about 1120 per ounce. Now, there was a rally in the first half of the year. And if you had bought gold, or if you were trading gold or investing in gold, you were feeling pretty good about yourself by June, because as you can see, we'd rallied all the way up to 1260. And you're like, hey, look, I'm reading this right, man. We're doing great. Everything's going along just as according to plan. And then look what happened. Right there at the end, right before gold took off, as we were, dealing with that second quarter that was at 3.7% GDP growth in 2010, gold fell, and fell substantially from about $100, from 1260 down to 1160 between June and into July. And then, of course, we know what happened next. Price turned. It moved up almost consecutively at a 45-degree angle in the back half of the year, rallying to $1,400 by the end of the year, and of course, rallying to $1,900 an ounce by September of 2011. Problem, and the reason I want to show you this is that, again, as 2010 unfolds, price was going sideways. And now here we are in 2019 with the year unfolding almost identical to 2010. And once again, price is going sideways. In fact, over the last couple of months, it has fallen about $100, $70 or $80, $90 from the recent highs that we had in February. Well, does that not look at least somewhat similar to that chart I'm showing you here from 2010? And if you gave up in 2010, in the summer of 2010, and threw your hands in the air and said, nope, the Fed, they've got this figured out. They've got everything under control. Gold's going down. It's obviously going back into the triple figures. I'm going to give up. Well, look what happened. You were right in the end, and price went higher. You just didn't hold in there. And then you end up chasing. And that's never a good idea. Same thing can be said for silver. That's the last chart that Carrie will put up. Again, showing you a similar pattern. Silver went sideways, flat at about these price levels for the first 7 or 8 months of 2010. And then what happened? Almost straight up from 18 to 48 in 8 months. Can we see that again in 2019 as it turns into 2020? Yeah, sure. Why not? Will we? It's impossible to say, but I think you can clearly draw the inferences here that where we are in 2019, very similar on multiple levels to 2010. And now is not the time to give up. In fact, now is the time to be positioning yourself to profit from this, whether it is an additional acquisition of physical metal or acquisition of really, really high quality, very well run mining companies. And I think that would be, you could use that, Carrie, as a segue into the discussion about Oren, because Oren's a company that I've been familiar with now for a couple of years. I am a shareholder myself, and I encourage everybody to listen very closely to what comes next here, because I think you'll recognize it as a great opportunity on its own, much less, gosh, you just imagine what could happen if all of a sudden precious metals and industrial metals start to soar. So, Carrie, thank you for having me on. Just one last thing I'd like to encourage everybody to check out. My site, I think, is an extraordinarily valuable resource as this all begins to unfold. I just want to offer everybody that's listening today a chance to just come check it out. If you come to TF Metals Report and you click to subscribe, it's usually $12 a month, but I'll give you half off the first month. We'll make it $6 a month, just so you can kick the tires. And if you see if it's something you want to be a part of, you just go to sign up. You sign up, and at checkout, you enter the coupon code of GOLD in capital letters, GOLD 2019. That'll give you half off your first month, give you a chance to check out TF Metals Report and see if we're leading you down the right path here this year. Anyway, thank you, Carrie, for having me on, and I'll stick around. I can't wait to hear what the guys have to say about Oren.
Thank you, Carrie. Our introductory speaker is Collin Kettell. He's a well-known mining financier, entrepreneur. He's involved at the directorship and the management level, co-founding even several mining companies. He co-founded Palisade Investments, has a very popular online radio show, Palisade Radio, And if you are a follower of the junior mining sector, you know that Collin was one of the leading voices teaching people and educating people regarding the opportunities that exist in the uranium equities going back to 2014, 15, 16, 17. Collin and his show really raised awareness amongst the resource investing community of the opportunities that are in uranium. So we thought it would be fitting that he would share and give you his thoughts on why he's investing in uranium equities now. With that, Collin, I pass it over to you.
Well, thank you, Bill, for that introduction, and thank you to Carrie and all of the organizers here who have put this event on, including the attendees who have taken some time out of their evening, afternoon to come and listen to this. I'll try to keep my discussion here succinct, as I know everybody wants to get back to things after this. We want to get through this all quite quickly. I would definitely characterize myself at this point in time as a uranium bull. So I'm going to spend probably about 10 minutes here just making the case and providing a bit of a background on myself and as it pertains to the uranium space. I currently run a company called Palisade Global, and Palisade Global is an investment company that was founded about 6 years ago at this point, focused almost exclusively on the resource space. I'm also the CEO of a public company by the name of Victory Metals, which trades on the venture exchange under the symbol VMX. It's actually a vanadium development company focused on developing an asset in Nevada. And I'm also the CEO of a private company called Radio Fuels, which is a uranium-focused company in the Athabasca Basin. As a disclaimer, I am a shareholder of Blue Sky Uranium. I've been a shareholder for some time, and I'll touch on that kind of towards the end of the discussion, just on a couple points why Blue Sky is such a compelling and interesting story. I'll start off by kind of giving a background on how I got into the resource space. When I was about 12 years old, so in 2002, I remember distinctly my dad picking me up from middle school at the time, and he had just gotten into the resource space a year or two prior to that, before he was an electrical engineer working for companies like Boeing and NASA. And for some reason around that time, he got the inkling that speculating in the commodity resource space might be a good place to do that. And in hindsight, of course, it was the beginning of a, depending on how you look at it, 7 to kind of 10 or 11 year long, really super cycle in the resource space. And one of the biggest benefactors of that happened to be uranium. And in fact, anybody who thinks back to that time will probably look at uranium as the biggest success story of that super cycle. And so when he picked me up that day in 2002, he told me that he had just bought a past producing uranium mine in Arizona. And of course, at that age, I had no idea what uranium was. I might have heard of it in the context of a nuclear bomb in history class, but I didn't have any context to its use in the energy space. And he had bought that asset in 2002 when uranium prices were at $7 a pound, probably for about $50,000. And over the course of the next 5 years, I watched him in a private setting, so as a private company, raise about $15 million. And by 2007, the company was worth $70 million with very little advancement. And the reason for that is that the uranium price saw a historically unprecedented move, going from $7 a pound to its peak at over $130 a pound, which for those who are not a commodity investor, commodities can move quite dramatically, but that move probably trumped just about any other move that most commodity investors are familiar with. So that brings me to the topic of today, which is why uranium and why now. In 2011, a disaster happened there was a earthquake off the border of Japan, and most people probably know that created a tsunami that then created the Fukushima disaster, and that was very similar to a 3 Mile Island in many ways, and that it put a big damper on the uranium space. And that caused a lot of the uranium companies that were public to really lose investor interest, and there was a bit of a dark period for the uranium space, and that has continued to persist in many ways up until today, but there's definitely a resurgence that's starting to happen. If you talk to any of the major resource speculators in the business, the names like Rick Rule or Doug Casey or Marin Katusa might come up. And what you'll find is that when they talk about the resource space, they'll really obsess over uranium. And a lot of their stories about their major successes will come back to uranium. And that's definitely something that I will touch on in the few minutes here that I continue to discuss. I've kind of broken my talk up here into 5 points why uranium, not just today, but in general, is such an obvious space for a resource speculator to be, and why it has the potential to make such large returns. And the first one that I'm going to start with is the title of, "It does not get more contrarian than uranium." If you look at the commodity space, and you look at it in the context of this year and last year, there's been quite a few commodities that have really started to run. From 2011 to 2015, all the commodities were in a bear market. The commodities really started to bottom out 2015 and started to have a move in 2016. So if you look at vanadium, for example, that's up 300-400% in the last couple of years. Palladium is a metal similar to platinum. Palladium just reached an all-time high. Even gold, it certainly doesn't have the shine that it's had at certain periods, but it's well off of its bottom. And yet uranium is pretty close to a low. It's trading on the spot market right now at about $25 per pound. And that's a significant number because globally speaking, you need about $40 a pound at an absolute minimum for most producers to make money or to incentivize companies that are developing assets to go into production and demand the capital needed to go into production. And as a speculator in the resource space, one of the things that I always look for and many speculators look for is what is depressed right now. Things that are at their lowest price given time will turn around and will produce very good returns because coming off the bottom, you'll get the biggest return. So right now, we're in a situation that is very akin, as far as I'm concerned, to where we were in 2001 and 2002, where uranium was at $7 a pound. It bottomed out, and then it had that epic run up to $132. So I think there's a lot of similarities there. The second point that I want to go over, and this is one of the most important ones and why uranium produces such great returns, is scarcity. So if you look at the resource space as a whole, most resource companies are listed in some way, shape, or form in Canada. About 70% of resource companies globally are listed in Canada, and the rest of them are primarily listed in Australia as well as London. 50% of those resource companies are focused on exploring for one commodity, being gold. So about 50% of the dollars that go into exploration go directly into exploring for gold. And that's despite the fact that gold companies, the amount of metal that comes out of the ground is 15%. So gold represents 15% of the dollar value that's extracted out of the ground globally. Yet despite that, 50% of the dollars go into gold. Uranium, on the other hand, and if you look at 2002, there were somewhere in the range of 5 to 8 publicly listed companies that were exploring for or developing uranium assets. And what that produces is a huge amount of scarcity. Scarcity in that when resource investors decide that they want to get exposure to something, they don't have very many vehicles to look for. And so if you can imagine, all of a sudden, thousands of people decide that because the uranium price is going up, that they ought to have exposure to uranium. There's very few vehicles for them to enter into. And what you saw in 2002 is that these companies would go up so quickly that if you weren't already in, there was no way to get in anywhere close to the bottom. We actually saw a similar event, but in much smaller scale, happen in 2016, which is when uranium bottomed at $18 a pound and rose to about $28 a pound. Now remember, both those numbers are well below the cost of incentivization for uranium, yet speculators did quickly jump on the bandwagon to try to get exposure. And there are numerous companies that went up over 100% within a matter of a month or 2 months. For that reason, uranium has the biggest moves out of any resource sector stocks, maybe only paralleled by a very weird group of metals called rare earth metals. But uranium kind of stand alone in that respect. And I'll point to one example that I can remember, which is Energy Fuels, which is a very prominent uranium company to this day that's actually producing uranium. But in 2006, in 1 year alone, Energy Fuels' stock went up 45 times. So if you had invested $100,000 at the beginning of 2006, that would have been worth $4.5 million by the end of the year. And while that's the only one I'll bring up right now, I can tell you that Energy Fuels was not alone in that sector. Every single uranium stock went through the moon that year. And that's the kind of thing that's exciting for a resource speculator to look for. The third point that I want to touch on today is price sensitivity. So uranium stocks, just like any resource stock, is a leverage play on the actual commodity that underlies it. Going back to gold, if you think that gold is going to go up, you could simply buy bars of gold. Today, gold is at around $1,300 an ounce. If you buy gold and gold goes up to $2,600 an ounce, you've made a double. But if you invest in, say, Barrick Gold, which is the largest gold producer, they have a much bigger impact from the price of gold going up from $1,300 to $2,600. It has a huge implication on the profit margin that they're making. In fact, like many uranium producers today that are losing money, all of a sudden when the price of uranium were to double, those companies would not be losing money anymore, but they might be making a lot of profit. And that's the kind of thing that drives a stock up. Why is uranium so exciting in this realm? Well, if you look at other energy-related metals or resources, let's say oil, for example, if the price of oil goes up by a double, all of a sudden people stop taking less road trips. They might stop running their heater as much in the winter. There is a very clear relation between the price of the underlying commodity and the amount that people use on the backside. And uranium is very different in this regard, because if you think of a nuclear power plant being built, that's typically in the range of a $10 billion capex, which is why uranium power plants are built essentially solely by governments or private partnerships with governments. The cost and the time to put that uranium plant in production takes years and years and costs a lot of money. The fuel that goes into that reactor once it goes live is anywhere between 3 and 8% of the costs on an annualized basis to run that nuclear power plant. And so what we saw from 2002 to 2007 is that even though uranium prices went up significantly, it did not curtail the demand that was required from the utilities to buy that resource. And so that's another thing from a speculator standpoint that's very exciting, is something where the market can deal with a much higher price, because certainly the stocks we own, the uranium producers benefit, but at a certain point in most commodities, that benefit is curtailed significantly by a cutback in demand. The fourth one, which I've touched on already a little bit, but is worth talking about more, is that mines don't get built overnight. And this goes for any mines, no matter what the commodity. If you think about the process that it takes to put a mine in production, even in a mining-friendly jurisdiction like Nevada, once you have a gold mine ready to go in production, you have a permitting process that's going to take anywhere between 2 and 4 years. And then you have a 1 to 2 year time frame to actually build that mine before you start recovering gold and being able to sell it on the backside. Uranium, because it is a nuclear substance, has a lot more stringent requirements by the governments around the world. And this is why a uranium mine takes longer, than any other type of mine globally to go into production. In fact, the timeline is usually 10 years plus. And so this means that the impact of the price of uranium going up, which will drive stocks up and it'll drive the profit margins for current producers, will have a very long lag time to actually incentivize new production all the way through to production. And this means that there's a lot longer of a cycle for a uranium bull market. So if we are in fact at a bottom right now and the uranium price does start to move in the immediate term, you can expect that cycle to last for a significant amount of time, which means as an investor, we have a long time that we're able to benefit from that, and essentially a very long wave to ride and profit from. And the fifth point that I want to touch on is that uranium is number one. And what I mean by that is going back to my opening statement, the Rick Rules, the Marin Katuses, the Doug Caseys of the world, when they sit there and reminisce on their most successful ventures, every single one of them will point back to a uranium company that they made 10,000% on. You can think of Rick Rule with Paladin. You can think of the energy fuels scenario that I brought up, which many of these speculators had a significant position in. And those are just to list a couple of many. I remember a company called J&R Resources in 2003, I believe, that a few people I know got in on a 10-cent financing. And within a matter of a few months, that stock was at $4. And these are the kinds of returns that resource speculators like myself live for and have nostalgia about thinking back on, because that's why we play the game, is to make returns that are life-changing. And I think that just about any resource investor that you'll talk to that's been in the game for a while and has had a massive success in terms of their career will point back to a uranium company very well being integral to that story. So those are the 5 points on why I find uranium to be so compelling. There's a lot of people right now, and some of those names that I just mentioned, that are really stacking their chips into the trade. And without diving into a long explanation, the here and now is that the uranium price has been depressed for going on 7.5 years now. That's a very long time for any bear market to go on. And there's certainly been a resurgence in terms of interest that's coming into the uranium space. It's not quite the same as it was in 2002, where there were only 5 to 8 companies publicly listed that are exploring for developing for uranium. But that number did swell to over 500 companies at the top in 2007 to 2010. And that number has come back to probably being well below 50 companies. And they have been, for the most part, underfinanced for the last few years. And there's not a tremendous amount of investor interest. But what I can tell you from the smart money and the Rick Rules of the world is that they're deploying a significant amount of capital into the space. I'll kind of leave the discussion with saying that in December of 2016, Palisade Global, my company, saw something happening, which was that the spot price of uranium, as it was traded via the public market. There's a public company that actually has exposure to uranium that typically trades at a 5 to 7% discount to the price of uranium in bad market conditions. But at that time, I noticed that all of a sudden it started trading at about a 5 to 8% premium. And that's when uranium prices, spot prices, were still all the way at the bottom at $18 a pound. And we called for the beginning of a bull market. And 2 months before that call, indeed, the spot price of uranium in hindsight had bottomed. And it went from $18 all the way to above $30 a pound. And if you were in uranium stocks at that time, it would have been hard to not make 200% your money over the next 6 to 8 months. Fortunately for everybody that's on the call here, including myself, the uranium price has pulled back significantly, and it's now at $25 a pound. So there's almost a second opportunity. But I would stand firm in my belief that the bottom in uranium was absolutely hit at $18 a pound, and that's over 2.5 years ago now. And I think that this next move, when it happens, and I sense that it's happening now, is going to be the last opportunity for people to get in at a base price. And what you'll notice is a lot of the stocks right now are trading at 5-year lows. They're trading along the bottom. And there's a huge opportunity to be had right now. And that's why my company is deploying quite a bit of capital into the uranium space. Blue Sky Uranium is one of the companies that we have a significant amount of exposure to. And I'm going to pass the discussion over to Nico, who is the CEO of Blue Sky Uranium and somebody I have a lot of respect for. But one of the reasons that I really like Blue Sky Uranium is a concept that I call reflexivity, which you can think of as the rubber band effect. And that is when a rubber band gets stretched to an extreme point and then tides turn, that rubber band typically goes back to where it was before. And Blue Sky Uranium has a very big move that happens whenever the uranium price shows signs of moving up. It moves a lot more than many of the other uranium companies that have been around for a long time. There's also a significant asset base with a sizable resource in Argentina that Blue Sky's put together, and there's a lot of upside to be had in that resource. So there's a lot more to be found. And Blue Sky, despite the fact that there has been a bear market for the past few years, has managed to finance and has managed to push the development of that asset along while other companies have not been able to. And I give Nico and the team a lot of credit for that, and I'm a big supporter because of that. And I could keep talking, but I know that time is limited here, so I'll pass things over to Nico at this point and thank everybody for the ear that they've lended for my discussion.
Adrian, welcome.
Well, thank you very much, and thank you, Kerry, and show my screen. Thank you very much, Kerry and Bill, for inviting me, and thank you, David, and all of the people at Sandstorm for including me in this presentation. So I'm going to talk a little bit about royalties, the royalty model, what some of the advantages are, and also what some of the disadvantages are. This is a person counting his money, as you can see, very happy because he's invested in royalty companies. Now, when you think about it, if you want to invest in gold, there's sort of several ways you can do it, but essentially you're looking at buying physical gold itself, and then if you want to buy stocks, you're looking at the big mining companies, the smaller mining companies, the exploration companies, and lastly, the royalty companies. And I'm going to start talking about royalties by looking at some of the problems in the other ways of investing. We know that mining is a very, very difficult business. And I'm not going to go through all of this. We could talk for hours about how difficult mining is. Robert Friedland likes to say that Murphy works overtime in the mining business. of all of the problems, I think one is that we all know about is the reserve depletion and the fact that there are fewer and fewer big discoveries being made, and yet the big mining companies have to replace those ounces every single year because it's a depleting asset. I also think it's fair to say, or it's true to say, that many of the major mining companies have exacerbated the inherent problems in the mining business by poor decisions, primarily by overpaying for marginal assets when the market is hot. And the result we see here, this is a return on equity of mining companies. And of all of the sectors, subsectors around, mining is one of the very worst for return on equity. Over the last half century, in fact, the mining sector has actually lost money on the money that it has raised. Not very good. And so, not surprisingly, the mining stocks have not done particularly well. The lower line here is actually gold stocks, and the top line is the S&P. But many of the major mining companies like Newmont, I'm not picking on anyone, Newmont, Barrick, Goldcorp, Anglo Gold, their prices are lower today or as low today as they were when the bull market started in 2001. Now, what about looking at the other end of the equation, looking at exploration companies? Well, they have their problems too. The biggest problem they have are the long odds of making a discovery. I put 1 in 10,000. Now, that number is the number that Newmont's chief geologist came up with for saying that only 1 in 10,000 anomalies becomes a deposit large enough for Newmont. But even if you look at smaller deposits, the normal number is 1 in 1,000 anomalies ever becomes a mineable deposit. And when we say mineable, that doesn't necessarily mean it's going to make money. It just means it becomes a mineable deposit. So that's one major problem. The odds are remarkably long. The second major problem, frankly, is that because exploration companies don't have any revenue for the most part, they have to continually raise equity in the market in order just to keep going. This is a graph just showing that table, rather, just showing 1 year from September 16 to September 17. I just picked a year, and I picked 8 exploration companies, and they're not even at random. These are companies that we have at some point owned, but I picked 8 of them at random from the ones we have owned, which I would like to think of the better ones. And you can see the extraordinary dilution of many of these companies within a single year. And if you go down to the bottom, this particular company, I'm not picking on anyone, so I'm not going to name names, their shares outstanding doubled in the course of 12 months. And this particular company actually has seen their share count go up by almost 9-fold since 2011. Now, what this means is that the company, the actual assets, the actual value, the worth of that company has to multiply, in this case by double within a single year, or over a period of 8 years, it has to go up 9-fold for each individual share simply to be worth the same as it was at the beginning of the period. And so it doesn't work out very well for these companies by and large. So we have problems, inherent problems with the mining companies, inherent problems with exploration. As they used to say on television many years ago, the young people might not recognize that, but that's a television, and those 2 little things sticking up at the back are rabbit ears. As they used to say on the soap commercial, there is a better way. And the better way to me is a royalty model. I'm not going to go all the way through this. David might want to touch on some of this. I think a lot of you listening to this will probably be familiar with the benefits of royalty companies over both mining companies and gold ETFs. And royalty companies, as you can see, have the potential to pay a dividend. They certainly have leverage to the gold price. Their costs of all type tend to be lower than mining companies. And in fact, some of the royalty companies actually have lower G&A costs than the gold ETF, which has insurance and storage to take care of. And that's just astonishing when you think of it. So David might want to get back to that. So how does that work out, comparing mining companies with royalty companies? And here I'm only going to look at the largest royalty companies. This looks at cash flow, and you can see that from 2008 through to the end of last year, you can see the trend for Barrick over the last few years, for Newmont, for Anglo, and then you look at the big royalty companies during that same period when cash flow for the major miners was declining. The cash flow, though volatile, the cash flow is going up for the major royalty and streaming companies. Another way of looking at it is the stock price. And not surprisingly, if cash flow is declining, the stock price tends to decline. So we see for the mining companies, sharp declines in stock prices. At the very same time, the large royalty companies see their stock prices going up. Wheaton, of course, this is Wheaton Precious Metals. They had their own particular problem with the Canadian tax authorities. But still, the trend here is up, and the stock price is higher today than it was in 2009, which is not the case for most, not all, but most of the major mining companies. Now, I said that I wasn't going to touch base a lot on the advantages of royalty and streaming companies because they're sort of well known, and David may want to discuss some of them. But there are some disadvantages, and the disadvantages, I think, are mainly fourfold. One is, and we have to recognize this, other people control the assets. So a royalty company which has a royalty or stream on another asset is not in charge of that particular asset. There are ways to mitigate that, but you're not in charge. The second one is that royalties and streams can burden a project. Some projects have two, and I've even seen two royalties and a stream on the same project. That makes it very, very difficult for that project to actually make money. Now, again, this can be mitigated, and it has been mitigated by several of the companies, which will renegotiate the royalties, because obviously it's to the benefit of a royalty company to get the projects up into production and generating revenue, and some revenue is better than no revenue. So royalty companies and streaming companies can sometimes renegotiate. But that's another thing you have to be aware of. The last two are criticisms that people often make of royalties that I honestly don't think are necessarily true. A lot of people say, oh, well, royalty companies are great when the market's bad, but boy, when gold is going up, I want a company with leverage. And I think that is a total misunderstanding of royalty companies, royalty and streaming companies, and a misunderstanding of the built-in leverage that many of these companies do in fact have. I'm not pretending that in a strong gold market, the royalties will necessarily be the absolute top performers, but they definitely do have leverage, and I think David will talk about that. The last criticism people make is that the stock, well, yes, royalties and streams are great. I wish I'd invested 20 years ago, but I've missed it. The stocks are expensive. And, you know, when you look at some of the price earnings of 142 times earnings and 4 times book and so on, they do appear expensive. But again, that's perhaps something that we can touch on later. So this is the best picture I could find of a man having his cake and eating it too, because that's what you get when you invest in royalty and streaming companies. You get defensive attributes that everybody thinks of, but you also get good performance in strong markets. So this is a graph, a chart rather, a graph of some of the largest of the royalty companies in down markets, and you can see they all outperform the XAU index of major mining companies. But equally in an up market, they also outperform, which comes as a big surprise to many, many people. But the royalty companies, which are seen as defensive, nonetheless outperform, and outperform by a wide margin in an up market. And this shows Sandstorm. I've added Sandstorm to this graph, and Sandstorm is actually the winner in this up period that I gave. So that's basically what I wanted to say. I just wanted to touch on a few thoughts about royalties and streaming companies, and then perhaps in the Q&A we can touch a little bit more on some of these points. But I appreciate the attention.
Thank you for listening to this Mining Stock Education podcast. Please subscribe and share with like-minded investors. Visit us on the web at MiningStockEducation.com for more resources on precious metals and natural resource investing. At our website, you can also sign up for our free newsletter for interview transcripts, stock picks, and more. This podcast is for informational purposes only and is not to be considered personal legal or investment advice or a recommendation to buy or sell securities or any other product. We make every effort to be accurate, but the information presented is not to be considered infallible. It may contain errors, and we offer no inferred or explicit warranty. If personal advice is needed, consult a qualified legal, tax, or investment professional. Do not base any investment decision on the information contained on MiningStockEducation.com, our podcasts, or videos. Make sure you always conduct your own thorough due diligence before investing. Realize that we may hold equity positions in or be compensated by some of the companies we feature and therefore are biased and hold an obvious conflict of interest. For our full disclaimer, please visit our website.